Russia has promised massive reprisal against Western assets in reaction to Western partners' freeze of Russian cash. The stakes are high, with Western assets in Russia worth some $194 billion, including $32 billion controlled by U.S. firms and $90 billion by European entities. On December 16, 2024, the European Union implemented its 15th sanctions package against Russia, escalating the ongoing economic confrontation. The Kremlin has imposed a number of restrictions impacting Western corporations, including an obligatory 50% discount on assets from hostile countries transferred to Russian buyers, a 15% departure tax on exiting enterprises, and special C accounts that limit earnings repatriation. Russia has also taken tangible steps against Western corporations, seizing over 700 million euros from 3 Western banks, expropriating assets from companies such as Carlsberg and Danone, and placing Italian firm Ariston and German company BSH Hochgerät under Gazprom's temporary external administration. At a minimum, Russia has around $288 billion in Western assets on its territory, albeit this figure should be regarded with caution because $98.3 billion of the $223 billion allocated to European countries originates from Cyprus, a well-known tax haven for wealthy Russians. Germany, Russia's former key trading partner, has only approximately $17.3 billion in stranded assets. Western firms continue to have significant exposure in Russia, with EU and US companies holding around $194 billion in assets there. Of this amount, $32 billion belongs to American corporations, while $90 billion belongs to European businesses. In response to Western sanctions and the G7's decision to use blocked Russian assets to aid Ukraine, Moscow has taken punitive steps. In April 2023, Putin issued a decree empowering his government to temporarily seize foreign corporations' assets in Russia. The Kremlin has also put stringent requirements on Western corporations seeking to depart the market, such as an obligatory 50% discount on asset sales and a 15% exit tax. Many Western enterprises who had planned to leave Russia after the 2022 invasion have been unable to do so due to regulatory impediments and probable losses. The corporate exodus has already cost Western corporations more than $107 billion in write-downs and revenue losses. Furthermore, Western corporations that continue to operate in Russia are unable to repatriate their revenues, which must be stored in special C accounts within Russia. Most recently, Moscow has promised additional reprisal if the West succeeds with its intentions to confiscate Russian assets. The Russian government has warned of legal ramifications and labeled Western actions as criminal expropriation. Russian Foreign Ministry spokesman Maria Zakharova has stated that Russia has a large arsenal of political and economic responses at its disposal, but no particular retaliatory moves have been announced. The true value of Western assets in Russia is likely to be higher than the $288 billion officially stated, since multiple criteria point to concealed or underreported ownership. The intricate web of offshore institutions and tax havens, particularly in Cyprus, which accounts for $98.3 billion in declared European assets, suggests that many assets may be hidden behind clever financial arrangements. Corporate structures and joint ventures exacerbate the situation, particularly in the energy industry, where Western companies have major concealed shares in partnerships with Russian firms such as Rosneft, Gazprom, and numerous oil and gas projects. Many of these arrangements have intricate ownership structures, making it difficult to determine their genuine value. The matter is further exacerbated by the fact that some Western corporations continue to operate in Russia through subsidiaries or different structures, potentially undervaluing or concealing their assets through various legal processes. Over 1,400 international enterprises continue to operate in Russia, many of which have complex organizational systems. The Russian government's recent measures, notably a confidential decree enabling the purchase of Western assets at large discounts, raise the possibility that Moscow is attempting to control significant unreported assets. Furthermore, the presence of imprisoned multinational companies, as well as the difficulty in appropriately evaluating these assets in present market conditions, make it impossible to identify the exact scale of Western interests in Russia. The existence of Special C accounts and various financial structures used to retain Western company earnings within Russia raises the possibility of huge, undeclared, or underreported assets. Furthermore, the complexities of asset valuation under present sanctions and market conditions suggest that many Western holdings may be severely underestimated in official reports. According to Russian official media, the greatest Western investments in Russia are Cyprus, $98 billion, the Netherlands, $50 billion, the United Kingdom, $19 billion, Germany, $17 billion, France, $16 billion, and Italy, $13 billion. European corporations are more vulnerable to Russian reprisal than American enterprises because of their larger presence in Russia. Many Western corporations that had planned to leave Russia after the 2022 invasion are now trapped, with mounting bureaucratic impediments and potential asset confiscation. Putin has issued a regulation that authorizes strong countermeasures. Authorization for Russian courts to seize compensation from United States assets in Russia. Capability to confiscate Western assets if Russian assets are seized abroad. Threat of vengeance for what Russia considers Western thievery. Recent events have had a substantial impact on the NSD's ability to manage Western assets. Both the United States and the United Kingdom placed sanctions on the NSD in June 2024, following the European Union's earlier penalties in June 2022. This prompted a significant reorganization of Russia's custody system, notably for assets owned by investors from hostile countries. In October 2024, Russia made a big step by eliminating the NSD from the custody chain for Western-owned shares under Presidential Decree No. 840. This directive established a new parallel custody system in which shares of limited Type C accounts are transferred directly to local Russian registrars, circumventing the NSD. Several factors influence the actual worth of Western assets under Russian control. A significant chunk of the stated $288 billion was housed in offshore havens such as Cyprus and the Netherlands, implying that the true value of vulnerable Western assets could be far lower. Furthermore, the NSD's function has shifted from being the only custodian of nominee accounts at ISRU's registrars to a more limited position under the recent revamping of Russia's custody system has presented additional hurdles for Western investors looking to manage or sell their Russian holdings. Under the new structure, these assets are subject to stringent regulations, including necessary Russian government clearances for all transactions. This scenario has effectively locked many Western assets within Russia's financial system, notwithstanding the NSD's technical departure from the custody chain. On December 16, 2024, the European Union implemented its 15th sanctions package against Russia, escalating the ongoing economic confrontation. The new provisions provide complete protections for European corporations, handle Russian legal risks and fines, and create new derogations for central securities depositories to release frozen cash balances. Notably, the EU has extended divestment license deadlines until December 31, 2025, giving corporations more time to organize their exits. The financial ramifications of this conflict are significant, as Russia controls around $288 billion in Western assets via its National Settlement Depository. In contrast, the G7 and its allies have frozen around $300 billion in Russian government assets, with European jurisdiction controlling $220 billion of these assets. In reaction to Western sanctions, Russia has increased its punitive measures against Western corporations. Recent moves include placing German company Bosch and Italian firm Ariston under temporary external administration by Gazprom. Russia continues to impose stringent exit requirements on Western firms, demanding a 50% required discount on asset sales, a 15% exit tax, and special government commission approval for all business withdrawals. The December 2024 EU package includes further safeguards, such as a ban on enforcing Russian court orders that impose unwarranted economic sanctions on EU operators. The package also creates new methods for releasing certain frozen assets held by EU depositories and extends deadlines for European corporations to conduct orderly market departures. In light of these developments, the EU has issued specific warnings to operators, recommending them to consider closing their Russian operations due to the increasing dangers involved with doing business in Russia. On December 16, 2024, the EU adopted its 15th sanctions package, which includes comprehensive protection measures that will have a substantial impact on European enterprises working in Russia. Legally, these corporations now have stronger protections against Russian legal proceedings, such as anti-suit injunctions and unjust court verdicts. Companies can now seek compensation in member state courts for losses incurred as a result of Russian legal actions, as well as recoup damages from Russian parties that gain from asset expropriation. In terms of asset management, the package improves control mechanisms for frozen assets as well as exit strategies. Central securities depositories now have additional options for releasing some frozen cash balances, and divestiture license deadlines have been extended until December 31, 2025. This extension enables corporations to conduct more orderly market exits, with exceptional derogations provided on an individual basis to promote smoother withdrawals from Russian operations. The package's operational measures include transaction prohibitions for Russian corporations that violate arbitration agreements with EU counterparts. European corporations are now shielded from Russian lawsuit risks and fines, with specific bans on executing Russian court orders imposing unjust economic sanctions on EU companies. These steps, taken together, provide a more safe environment for European corporations to run their activities in Russia while planning their eventual market exit. The EU has made it plain that operators should carefully consider closing their Russian businesses due to the growing dangers involved with doing business in the country. This comprehensive protection package reflects the EU's commitment to assisting its enterprises in navigating the complicated process of exiting the Russian market while mitigating potential losses and legal problems. While both sides have attacked each other's assets, the extent and impact vary. The West's freeze on Russian state assets, notably central bank reserves, is a significant economic lever. In contrast, Russia's measures have mostly impacted private Western enterprises operating within its borders. This disparity highlights the West's stronger position in terms of state-level asset freezes, whereas Russia's efforts, while significant for individual firms, fall short of the scope of Western moves. The situation remains fluid, with continuing legal processes and policy discussions. The next court verdict regarding the RBI, scheduled for December 25, 2024, might have substantial ramifications for Western enterprises in Russia. Furthermore, conversations are ongoing inside the EU and among its allies about the potential use of frozen Russian assets to help Ukraine, balancing legal limits with geopolitical aims. The unprecedented use of the U.S. currency and international financial institutions as weapons against Russia has acted as a wake-up call to developing economies and geopolitical blocs, such as the BRICS. These countries, along with others in the global south, are now taking significant action to safeguard themselves against comparable vulnerabilities, advancing the goal of economic self-reliance and de-dollarization. BRICS led efforts to protect economies. One push for the BRICS currency. BRICS countries have expressed a desire to establish a unified currency to minimize reliance on the US dollar. This movement has gaining popularity as the dangers of dollar-centric systems become clearer. While still in its early phases, this currency would most likely be utilized for intra-BRICS commerce, replacing the dollar entirely. It is part of a larger effort to achieve financial autonomy. To China's leadership in de-dollarization. China, as the BRICS economic behemoth, has led the attempt to diversify away from the currency. The yuan has experienced greater use in global commerce, notably in energy deals with countries such as Russia, Saudi Arabia, and Iran. China's Belt and Road Initiative, BRI, offers funding and commercial settlements in yuan, encouraging partner countries to shift away from dollar dependency. The BRICS countries, led by China and supported by Brazil and India, are adopting aggressive measures to protect their economy from the weaponization of the US dollar. These policies are creating the framework for a more decentralized financial system in which countries have greater influence over their own economic fate. While the change will take time, the seeds of de-dollarization have already been planted, changing the global financial system for decades to come.